Hey guys, thanks for clicking on this video. Today we're going to be looking at something a bit different. We're going to be looking at some stock analysis and why I think this stock is undervalued and it pays a very nice and fat 5.77% dividend. So the stock in question is the Southern Copper Corporation, ticker symbol SCCO, and what this company does, it's involved in basically the entire part of the copper industry, mining, exploiting, smelting, refining copper, and then turning these into particular copper ores. And it is based and located in Phoenix, but its mining operations are across the majority of South America. So why do I think this stock is great? Well, firstly, it's at a good discount today, down 2.6%. Now, if we look at my steps to see whether or not this is a good stock, which is kind of a screening process, you can see the market cap is 46 billion. It pays a 5.77% dividend, and it has a share price currently of just over $60. So the first thing I like to look at is the P ratio less than the market. Yes, it's 17, which is less than 40, so that's good. It's also less than its sector. Basic materials as a sector, so it's undervalued in terms of the sector, so that's good. The revenue has gone from 7 billion to almost 10 billion, so that is another pass. Profit has gone from 1.5 billion to 2.8 billion, so that's a pass again. They are not buying back their shares, but the shares has remained constant, so I'm going to count that as a pass as well. And finally, as the free cash flow increasing, and this company has a lot of free cash flow, 1.1 billion to almost 3 billion. So that is 6 passes we can see. So this stock looks pretty good in terms of the screening process. And it has a free cash flow ratio of 16. So that's the market cap divided by the current free cash flow, which is 16, which is very, very good. Next thing we want to look at is the valuation of the stock. And you can see we've got a discounted free cash flow model here, and we're estimating the future free cash flows. We give it a value, discount it back, and then calculate the stock price. So even then, these numbers are a bit conservative. You can see that we're estimating that these dates are actually lower than the previous year. So with that even being said, you can see that discounted free cash flow gives the stock price at around $80 a share, which is 31.63% discount. And if we look at the Buffett Graham intrinsic value, this is a different way of modeling the stock, looking at earnings per share and growth, and that has a fair value of around about 83. So these are in line, which is excellent to see. It shows that this stock is undervalued, and it has a Graham price, which is a safe price. If you wanted to buy this stock and hold it for years and years and years, this is the Ben Graham price, and he would evaluate it around about $62.87 a share. So even according to that, he would buy it right now at its current price. So it's looking good. It has a lot of positives, a good dividend with 5.77%, and is currently trading at a discount according to discounted free cash flow and the Buffett Graham intrinsic value. So hopefully you've enjoyed this video, a bit different. Give a like if you enjoyed it. Give your comments down below on the stock, and also it's GameStop earnings today, so I'm going to be doing a later video going through that. So hopefully we've got some good news on GameStop, but if not, then who cares anyway? The DD's solid and the most will happen. So I'll catch you guys next time.